Whenever markets become volatile, investors start panicking, stocks fall, news channels start talking about the crashes, and suddenly everyone around me starts asking the same question: should I sell my investments? But I've also heard something interesting. Many experts say the biggest losses investors suffer are not because of market themselves, but because of mistakes investors make during the panic. So, what are those mistakes? That's a very important question because financial markets naturally experience the volatility. But during periods of uncertainty, investor psychology can make things worse. In this video, we will understand the most common mistakes investors make during market panic, why these mistakes happen, and how understanding market behavior can help the investors think more clearly. One of the most common mistakes during market downturn is panic selling. When prices fall quickly, investors may feel the pressure to exit their positions immediately. Their reaction is often driven by fear rather than long term analysis. But panic selling is not the only mistake investors make. Another common mistake is overreacting to the headlines. During volatile periods, news cycle becomes intense. Investors may respond to short term events rather than focusing on long term fundamentals. And sometimes investors make the opposite mistake. During uncertain times, some investors attempt to quickly shift their investment towards whatever appears to be performing well. This behavior can lead to poor timing and inconsistent investment strategy. But the underlying reason behind these mistakes is psychological. Financial markets are influenced not only by economic fundamentals but also by human behavior. Fear and uncertainty can cause investors to react emotionally rather than rationally. And understanding the psychology can help investors approach the markets more calmly. For many investors, maintaining a long term perspective can provide clarity during volatile periods. Markets experience cycles, and understanding these cycles can help the investors interpret the short term fluctuations. So, when markets become volatile, it is useful to remember that uncertainty is a natural part of financial market. Understanding how markets behave can help investors avoid common mistakes during periods of panic. If you want to understand how markets work and how investors think during volatile periods, subscribe to the channel because we break down the economic and behavioral forces that influence the financial market.